Welcome to the AWA Market Minute, breaking down current economic, financial, and political events that impact today's retirees. Our investment committee performs hours of research and analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring investment advisors Jaron Monk, Mason Page, Chief Investment Officer Scott Hoxer, and your host, founder and CEO, Paul Coles.
Awesome. Well, welcome everybody to this month's Market Minute. We're excited to have everyone join us. Scott and I were chatting about a trip I had this weekend, and kind of a cool thing happened while we were away. We were boating with our family. We've got 4 little kids, and we like to wake surf. My wife and I get up and we like to enjoy wake surfing. Our kids have tried all summer long to wake surf, and they've been able to boogie board and do a couple of things, but they can't get up behind the boat wake surfing. None of them have been able to, and our kids range in ages from 6 to 14, and none of them have been able to get up wake surfing, though they've made token efforts. They've not been able to do it. Well, I talked to my 12-year-old son over the week, and I said, look, this is going to be your best attempt, your best effort. We want to see you wake surf. And he said, Dad, I don't think it can be done. And I told him a story about running the sub 4-minute mile, and how for 100 years it was believed that you could not run a sub 4-minute mile. It was believed it was humanly impossible to run a sub 4-minute mile. And then in 1956, somebody ran a sub 4-minute mile. They broke this limiting belief that it could be done, the misinformation that it couldn't be done. And within a matter of months, hundreds of people followed suit and were able to run a sub 4-minute mile. So I told this to my son. I said, you can do it. And he finally got out there and he did it. He got up and he surfed. And the minute he got up and he surfed, 2 of my other 4 kids followed suit immediately thereafter. They got up and they surfed. So 3 of my 4 kids, everybody but the 6-year-old, surfed this weekend. And it was kind of fun to watch them peel back this kind of misinformation that it can't be done, this belief that it couldn't be done, and how that belief actually impacted their behavior, their attitudes, their actions. So today we wanted to play a game with all of you, and the game is designed to say, look, today's retirees are bombarded with information, and a lot of this information is misinformation. It's information designed to maybe sometimes sell a product. You'll be on the radio and they'll talk about now is the most important time to buy gold. And it's hard to know, is that really a factual piece of advice and information that is applicable to you, or is it an advertisement that's selling something? And you get social media, you'll get TV, you'll get all sorts of news outlets that are kind of pummeling you with information. And sometimes that information really impacts your belief system. It impacts your actions. It impacts how you intend to go kind of navigate through these murky waters that we're in today with today's economic and political environment. And so today we wanted to play a game where we're going to give you a dozen questions and talk through these questions, and they're designed to test your skill at spotting some of the misinformation that might be out there, or the beliefs that might be out there from fact, from fiction. And then we'll talk through some of these questions together, Scott and I, as we kind of talk through you. So let's start out with the first question, and we're going to give everyone a chance to maybe get 5 or so seconds to just answer these questions. At the end of the game, we are going to announce a winner to see who got the most of these correct. So the first question, let's go ahead and launch it, Andrew. From 1997 to 2021, the S&P 500 annualized return. So if you'd invested $100,000 in the S&P back in 1997 and held it through to 2021, what would have been the annualized return over that period of time? So give everybody a couple seconds to answer these questions. And we're going to cut these off, like I said, 5 or 10 seconds per question. So we've got plenty of time to answer those. All right. So let's go 3, 2, 1. We are done. So the majority said that they believed the answer was 10.9% average annualized return. The second question, however, was in fact 12.34% from 1997 through 2021. So a big chunk of our clients are extremely intelligent. They knew that over that 25-year run, the S&P has averaged about 12.34% per year. That's going to lead me into my next question. So let's go ahead and take that next question. Let's go ahead and launch that. The next question says, removing the best 30 days from that period of time, from 1997 through 2021. If I took the best 30 days the market responded, the best trading days of the 30, what would the change of that return be? What would my return actually have been if I took out the best 30 trading days?
30 days doesn't seem like many, right?
Over 25 years.
Yeah. It's like we're taking out one trading day a year,
Yeah,
right?
pretty much. Yeah. One to two trading days per year over the time frame. Okay. So the majority of you responded that my return would have dropped down to 10.9%. Would you guys believe it if I told you that the return would have dropped down? Go ahead and end that, Andrew, to 2.89%. Scott, this is crazy. So let's go ahead and share our screen here, because I think this is a good one to show what's going on here.
Yeah, as you're pulling that up, Paul, you think about it at 12%, your money's doubling in 6 years. At 2.89% or 3%, it takes 24 years for your money to double. So just being out of the market those 30 days is pretty compelling.
It's incredibly compelling. So here's what we're showing here. Is that showing up, Andrew? Perfect. Here we've got the S&P return from 1997 to 2021, an average annualized return of 12.34%, fully invested. But if I take out the 30 best trading days, the new return goes down to 2.89%. And what's really fascinating is if I take out the 60 best trading days, I'll actually see a negative return in the S&P 500 over those 25 years. So Scott, what's going on here?
Yeah, I mean, this speaks to the folly of trying to time precisely market entry and exit, right? I don't care how smart any one individual is. There's no way you're ferreting out what 30 days are going to be the ones that you need to be in the market.
Right.
Yeah.
So the concept here is how critical it is to be fully invested. And obviously leading into this fully investing idea needs to be a plan for retirement. And we've talked about this ad nauseum. Nobody is trying to guess what the market is going to do next. We don't have any, thesis that the market is bound for, full recovery mode this month. We don't know that. We really don't know. There's a lot that's going on in the market today that is causing us, a little bit of concern, right? Watching interest rates and inflation, watching the war in Eastern Europe and Ukraine, watching current political concerns right here domestically. It's causing the market the same volatility. The market tends to sell first and ask questions later.
Yeah.
So we don't want to be invested trying to guess what to do next. We want to be invested with a long-term financial plan, which is why our clients utilize smart retirement principles and understand that with the different buckets of money, we're managing cash flows between our green bucket, our yellow bucket, and our red bucket. We're all about managing cash flows. So let's lead into the next question here. Why is it, and we get this question regularly, why can't we, in talking about managing our red buckets, why can't we just pick the worst trading days, knowing when the market is in a bad spot, and just kind of get on the sideline during the worst times and jump back in during the good times? So let's go ahead and ask this question. The 30 best trading days since 1997 have generally occurred right in the heart of when? Record reported earnings and economic expansion, political control of a single party, 9/11, the tech wreck, the 2008 financial crisis, COVID-19, or 2+ consecutive years of geopolitical world peace. I kind of set this one up, unfortunately.
The audience agrees, Paul.
The audience agrees, polling the audience. Okay. interestingly, there's quite a few people that still are leaning on, so this is interesting, right?
Yeah.
So are we going to get the 30 best trading days during periods of record earnings and economic expansion? And let's go to end the poll. The majority did get the question correct. It was actually during the heart of the 9/11 tech wreck, the 2008 financial crisis, and COVID-19. So again, I'm going to share my screen here because I think this is really just a fascinating. See if I can share my screen here. All right. So look at this. The 30 best trading days actually occur during the highest periods of market volatility, right? 20% of those trading days occurred right during that tech wreck. 40% occurred during the financial crisis. And again, 20% again occurred right during the COVID period of time. I added up these trading days here during 2008 and 9. And keep in mind, these trading days from 08 and 09, this was not like at the end of the financial crisis. This was during.
Right in the thick of it.
Right in the thick of the financial crisis.
Yeah, look at the one on 9/30/08. That was right as things were melting down.
Right as things were melting down.
Yeah.
And if we add these up, it's nearly 70%.
Yeah.
I mean, can you imagine if we'd said, hey, markets are down, let's sit on the sideline during this period of time? We would have lost nearly 70% of what that return would have looked like. And so you clearly have to, have a disciplined approach to investing, and you can't be, subject to the whims of what this volatility is doing and how it looks and feels. So let's kind of leverage that into the next question, Andrew. Go ahead, Scott.
Yeah. So over the past 3 years, Microsoft and ExxonMobil are respectively up 18% Microsoft, up 80% ExxonMobil, down 11% Microsoft, up 20% ExxonMobil, up 94% Microsoft, up 17% ExxonMobil, up 18% Microsoft, up 80% ExxonMobil. Interesting to see how this one's trending.
Yeah.
All right, let's go ahead and pause it right there, Andrew. So we have a divided audience here. So kind of divided almost equally between the last three potential answers. So the actual answer is Microsoft is up 94%, ExxonMobil's down 17%. Or up 17%.
Up 17.
Yeah, this is surprising to people because year to date, Exxon's up 40%, Microsoft's down 25%.
Right.
And we throw this in there because it's important to zoom out from time to time and keep some context and keep some perspective in mind where, hey, notwithstanding the challenging year we've had over the past 6 months, stocks in the kind of growth side of the economy are still up significantly relative to those stocks that are surging this year.
That's right. That's right. And it's interesting to always try to chase the hot dot, and people get excited about that. Wayne Gretzky, famous hockey player, always said, if you want to be in the action, you need to go where the puck is headed. You can't always chase where the puck has gone.
Yeah, and I think it speaks to something behaviorally that we're all, I think, prone to. If you were given the proposition of, hey, if you give me $10 a year from now, you'll have $13. That's a good prospect. What about the prospect of, hey, you give me $10 a year from now, you'll get $15, but it's going to go to 17 and then back to 15.
Right.
And people psychologically have a hard time with that taking a step back. And it's because we're hardwired to feel the pain of a loss more than the joy of a gain.
That's right. The euphoria of the gains will never quite be as significant as the pain of a loss.
Right.
Yeah. And that's just the psychology of it. All right, let's look at the next question.
All right, and I'll take this one. So on average, the market falls by 20% every 4 years, every 10 years, every 7 years, or every 2 years. All right, let's stop there, Andrew. So this one, we have a, kind of divided audience as well. The correct answer here is actually every 4 years on average, we have a 20% fall or greater. So this is surprising to folks, right? And part of that is we've had such an extended bull run, right? Where, from 97 till present, we had, kind of 3 blips on the radar. But other than that, it was primarily a surging market.
And it teaches people erroneously what to expect.
Right.
People get into these habits habitually to say, well, I should always expect to have 15% returns in my portfolio.
Yeah. And I think it reminds us the price of admission into investing is volatility, right? Like there are no free lunches in life or in investing, and the price of admission is volatility. You have to be able to weather the volatility to get that 12% annualized return.
That's right. And during retirement, so long as we're willing to have, a plan, a proposal there of smart retirement, right? Our different buckets. Red buckets can be volatile.
Yeah.
They're designed to be volatile. That is the price of admission to getting those long-term performance gains, which we need in retirement in order to buy, the future version of ourselves, bread, milk, and eggs. Those have got to be exposed to that volatility. That is by design. And the cash flows that we are going to manage for today's dollars are being managed in green and yellow buckets. They'll refill our gray buckets. So this has all been thought through thoroughly. And let's actually compound the last question with another question. Let's just throw that next one up here. From 1950 through current, the average return on the year following midterm elections was what? 11.7%, 18.4%, down 1.4%, or 32.3%. So now we're talking about, we have a midterm election year from 1950 to now, and the current average return the year after a midterm election year. Okay, so let's go ahead and pause this one here. Okay, so the majority of you said 18.4%. Let's talk through that. I'm going to share my screen here. This is a really interesting phenomena. Okay, so here we see the S&P returns from 1950 all the way through currently, what midterm election years look like. And the intra-year pullback during that period of time, you can see, is usually really significant. This is so the idea that every couple of years we go through a market pullback is compounded when we introduce more question into the market of who's going to be in charge.
Yeah. Who's going to be in charge? What does political policy look like, et cetera? And there's a lot of uncertainty.
And the market, if it wants anything, it wants stability, and it wants certainty, and it wants to be able to predict what's going to happen next. And an intra-year loss during a midterm just says, hey, the market doesn't know. The market doesn't know. But then to the questions point, so here's the average. The average loss was 17.1%, and the average return on the year following the year 1 year later was 32.3%. So many of you got that right, 32.3%. But I think that, a lot of people think, well, that's a big number, and it really is a big number. That is the average year return 1 year following a midterm election. Now, we're not predicting. We're not saying, hey, next year is a 32% market year. We don't know that. I'm just showing you the historical returns, and past performance is obviously no guarantee for future results.
Yeah, that being said, investing is all about playing the percentages and kind of being on the right side of kind of where the odds fall. And what we're seeing in today's market is increasingly the deck is becoming stacked for a future, bounce. So we don't know when that will occur. To your earlier point, we don't know if it's next month, 6 months from now, or when that's going to happen. But with each day that passes, we become closer to that bounce.
Yeah, and you referenced cards and a deck and a stack. So let's throw some fun ones out here. The odds of winning at a casino game of craps. Okay, so what are the odds of winning at a casino game of craps? Go ahead, guys. Is it 48.6%, 24.2%, 88.3%, or 65.4%? What is the odds of winning? So a lot of times I'll hear this. People will say investing in the market is like gambling at Vegas. Okay, so what are the odds of winning in a casino game of craps? Okay, so we're getting overwhelming majority. Go ahead and pause that there, Andrew. Are saying 24.2% are the odds of winning at a casino game of craps. Interestingly, It's higher than that. It's actually 48.6% are the real odds of winning at a casino game of craps. This is going to lead us into the next question. So go ahead, Andrew, and take us to the next question. Yep. All right. So this one now, U.S. stocks, as measured by the Dow Jones Industrial Average, posted positive returns dating clear back to let's see here. What is the date on there? I think it's dating clear back to 1901. Going back from 1901, if I pick any 15 years, any rolling 15 years, what percentage of time did the Dow Jones or U.S. stocks report positive gains over any 15-year rolling windows from 1901 to 2021, 120 years? What percentage of time did U.S. stocks post positive returns? Okay, everybody's weighing in on this one here. Yep, let's go ahead and end it. Okay, the majority thought 92.7, which is a very optimistic audience, and we're grateful for the optimism. However, the answer is 99.9%.
Not optimistic enough.
Not optimistic enough.
Yeah.
In order to really, I'm going to show my screen one more time here. This is interesting, okay? Because a lot of people, I think, get in this idea of comparing the market with Vegas, and so here are all the different games that one might be able to play at Vegas, right? And the one I chose was craps because that was the one that actually had the highest. Well, I guess this Baccarat had a higher percentage. I didn't know what that game was, and so I didn't put that on my question. But you can see what the percentage of winning versus U.S. stocks over any 15-year rolling period of time. Any 15-year rolling period of time from 1901 to 2021, they returned a positive on 99.9% of the time. So if I stay invested over 15 years, anywhere from 1901 to 2021, 99.9% of the time, I'm going to post a positive return.
I think those shorter time frames are pretty compelling too, right? Like you look at a 1 year and you've got almost a 75% chance in any given year of markets having a positive return. I mean, those are tremendous odds, and it kind of speaks to the folly of the comparison. When you invest, you are taking equity ownership in a company with solid prospects.
That's right.
That's very dissimilar to going out and rolling the dice and hoping for the best.
That's right. Even more so when we're doing our due diligence into what you own and why you own it.
Right.
So you're taking an ownership position in a company with real earnings, and you're saying, I want to own certain companies that are producing and reporting real earnings, and I'll own some of that. I'll own some of that equity, and I can measure that over 120 years and see that it's a very positive experience over extended periods of time. So go ahead and throw the next question up, Andrew.
All right. So the question is, safe, long-dated U.S. Treasury bonds, meaning 20 years or more to maturity, are up 13% year to date, up 3% year to date, down 1% year to date, or down 20% year to date.
This one's interesting, Scott, because we get this conversation regularly where there's this old weird rule of thumb that people were taught, 50 years ago that says I take the number 100, I subtract my age, and then I'm supposed to put that percentage in safe, bonds.
Yeah.
Right? Because it's some kind of safe investment for me, right?
Yeah.
So let's talk through that.
Yeah. So go ahead and end it, Andrew. So pretty evenly split on this one as well. And I didn't tip my hand too much with this one. I have safe in quotes because these bonds have been anything but safe year to date. They're down 20% year to date. And one might ask, how is that possible? This is issued by the U.S. government. The U.S. government's credit quality is impeccable. They're always going to, pay their bills. How is it down 20%? And the reason being is it's long in duration or a long period to maturity. And the further out you go, as far as the maturity of a bond, the more sensitivity there is to changes in interest rates. And we saw a big bounce in interest rates to begin the year. And those longer dated bonds, regardless of who the issuer was, took a significant hit.
And we're not talking about credit quality here.
No, not at all.
We're talking about interest rate risk and maturity.
Yeah.
So if I were to try to sell something back on the open market, and it's a longer duration, but interest rates have gone up. I have to discount the value, what I'm going to sell it for.
Yeah.
And people don't understand this when they buy safe mutual fund bond holdings. They're getting the daily adjustment of those based on current interest rate movements. And we see all the time people come to us thinking, you know, they got their 401k and they're like, well, I'm in these safer, you know, bond funds. And we're like, have you watched,
Yeah.
you know, the performance? And they don't realize so much of that was exposed to this very issue. So let's go ahead and throw this next one up, Andrew. From 1957 to 2021, here what we're trying to measure is the behavior, the relationship between the S&P's annualized returns and corporate earnings. Okay, so what is the correlation between the S&P 500 and corporate earnings? Okay, and so we want to know what that looks like. Go ahead and take a guess. Is it 50% of the time they correlate? Is it 88% of the time they correlate? 97% of the time they correlate? Or is it 99% of the time they correlate? Okay, and we're getting a lot of good feedback here. Pretty well split once again. And I want to throw out there while you're answering these questions, we are going to give the winner of this quiz a $25 gift card. So think through these. Okay. So Andrew, let's go ahead and end there. The audience got this one correct. It's 90. Nope, they didn't. We did not get it correct. I apologize. 88% was what you guys said, but 30% of you got it correct. 97% of the time, there's a correlation between the earnings reported and the S&P 500 annualized returns. In other words, you are taking ownership in real companies with real earnings, and that, more than anything, is the single highest driving factor in the S&P's returns. Is saying these companies are producing real goods and services, and as they report their earnings, the S&P says, wonderful, we can correlate with those earnings based on our annualized returns. 97%.
Pretty remarkable.
Pretty remarkable. Okay, let's see what we got next.
All right, next question. Interest rates are forecast by futures contracts to peak in January 2028, July 2026, February 2023, or June 2024. So we know that the Fed's raising interest rates to curb inflation, and this question is saying, hey, when are those increases forecast to stop?
Yeah, and this is a great indicator. The market tends to be one of the best leading indicators of the market.
Yes.
Right?
Yes.
So this is saying of the economy, actually. The market tends to be a great leading indicator of the economy. So this is saying when does the market think interest rates are going to peak?
Yep. Yeah, and this is a very useful forecasting tool because this is people voting with their money, right?
Yeah.
This is as accurate as a forecast as you can get. So let's go ahead and stop it right there, Andrew. So the audience was, not too far off with this. February 2023 is when rates are forecast to start actually declining again. And so the thesis that the market has right now is that inflation that we have today isn't going to be nearly as entrenched as it was in the 70s and 80s, and that the rate increases that will happen the remainder of this year, we have a likely increase of 75 basis points this week. But the idea is the rate increases this year and those early next year will be sufficient to stamp out inflation.
Yeah.
Now we'll see if that actually happens, but that's what the market is forecasting.
All right, this leads us into the next question. Throw that one up here.
All right, consumer spending is currently rising modestly, falling modestly, rising significantly, or falling significantly.
And what is this indicating?
Yeah, so this is indicative of kind of like two things. One is inflationary pressures, and two is recessionary pressures. Are we on the cusp of a recession, or are we even in a mild recession right now? And we'll have some data this week. It's going to be a busy week for data. We'll have some data this week as to whether or not the second quarter of the year had negative GDP growth, right, which would suggest we're in a mild recession.
And while they're answering that, I think it's interesting and worth noting, an event doesn't happen when they announce we have entered a recessionary.
Right. Right.
We look at the data. It's a lagging data source that we look at, right? We look at a data set from before, and then we determine if there were 2 quarters of negative GDP. that is indicative of, yeah, we've now been experiencing a recession. People are like, I'm worried about the future. And it's like, if they announce that, it's because we lived it.
Right.
You
That's
know?
exactly right.
Yeah.
Yeah. All right. So falling modestly was our leading answer here. It's actually falling significantly right now. And there's an interesting behavior. And I heard this kind of anecdote the other day, and it rang true to me. During the 1970s, 1980s, during that inflationary cycle, people were rushing out to buy goods and services at that point in time because they were fearful of how much higher prices were going to be. We've hit a point kind of in our economy where people are waiting and deferring buying certain goods and services because they feel like it's going to be cheaper 6 months from now.
Yeah.
And that's a pretty big difference as far as inflation expectations
Versus recession.
Yeah, exactly.
And it's interesting because I think, to me, as I look at the data, and everybody can interpret it a little differently, it's very indicative of the Fed getting it right and doing their job.
Yeah.
Cooling off the economy enough that these inflationary pressures that we're all feeling, the price of groceries at Costco and the price of fuel at the gas tank and the price of going to build something. I mean, it's outrageous. And I think people are saying, I'll wait until this cools off. And the Fed's putting enough pressure on interest rates. They're saying things are actually slowing down already.
Yeah.
And I think that could be interpreted as a very good thing.
Right.
Yeah.
Yep.
Let's sort of last question up, and then we'll wrap up today's market minute.
All right. Last question is, compared to a basket of global currencies, the US dollar is down 5%, up 2%, up 11%, or down 13%. So we're seeing if we have a strong US dollar or a weak US dollar. Let's go ahead and pause it right there, Andrew. All right, so the people have spoken and they are spot on, up 11% year to date. So we have had a strong US dollar, and we wanted to share this particular data point because I think it speaks to some of the misinformation that was out there 6 to 8 months ago, right? The thesis then was, hey, the US dollar is on the decline. Cryptocurrencies are going to kind of supplant that. If we have geopolitical issues, if we have high inflation, the dollar is going to be taken out to the woodshed.
Right.
And we've seen the exact opposite, right?
As we almost historically have always seen during these periods of uncertainty.
Yeah.
People run to the US greenback.
Yeah, that's right. And so, you had the, marketers and others saying, hey, pile into crypto. Crypto's down almost 60% year to date, depending on the currency you're looking at, whereas the US dollar is, much stronger. The US dollar has, for modern history, been the world's reserve currency, and that hasn't changed.
No, hasn't changed. And again, once more, you can analyze this information and then draw whatever inferences you like from it. But I think it speaks to the overall underlying strength of our economy. Now, there's a lot of, stuff that's out there right now that's causing concern. But overall, we are seeing a lot of, positive indicators in our economy.
Yeah. And during times of stress, the U.S. remains like the least bad option out there, and it also remains, the most dynamic and robust economy in the world. When the world's struggling with the cold, the U.S. might only have sniffles and be over it fairly quickly.
So we'll wrap up here. Andrew's going to calculate some responses here, so we'll come up with an answer. In the meantime, before we announce our game winner and who we're going to send a $25 gift card to, we want to make sure everybody understands there's a lot of information out there today, and people are reacting to that information, and they're getting it from lots of different sources online. Like I said, media outlets, social media. They'll see things their friends are saying. They'll get it at the water cooler at work. They'll get it on the radio. And we want you to know you always have a team here at Alliance Wealth Advisors that spends hours and hours and hours every month trying to understand the information out there and where the good sources of that information really are. And Scott will often reference a term that we've come to use in the office, triangulating the truth. There are sometimes data points that you have to look at and say, okay, here's one data point, here's another data point, here's another data point, and the truth probably resides somewhere between those data points. we have a very strong vested interest as your investment advisor, and the firm has a very strong vested interest as your registered investment advisor to ensuring that your accounts, your retirement accounts, are in fact growing, and that they are in fact working in the best possible outcomes for in today's current markets, in today's current economic and political uncertainty. And we expect a lot of this to happen on a regular basis. This isn't something that caught us off guard or we weren't aware of. We understand this stuff is regular and we expect to see it. We don't want to have a bunch of overreactions to it. That can often be the most concerning, is the overreactions. So, all right, we did get an answer back, and it looks like the person that scored the highest on our test was Alan Johnson. So congratulations. We should have some kind of applause meter here to Alan Johnson. We're going to send you a $25 gift card for participating and getting the highest results back on our Market Minute. And for those of you who got low scores, just maybe remember there is optimism out there.
Yeah.
And there's reason to hold to your plan, and there's reason to say, hey, we've built a plan to weather these storms, and we don't need to overreact to the information that's being pushed out there today. Let's hunker down and stay in our planning, and not deviate from that.
That's right.
So we appreciate everyone who joined us for our Market Minute today. These are always a lot of fun for us to do, and we'll send this out on recording for everybody to be able to see it later. And until next time, take care, everybody.
Thanks.